Hello and welcome everyone to yet again another Live at 5 by the property podcast experts. We come to you with the gripes and grapes and the fruit of our labours of this last week and the points of contention and things that we've learned in our businesses that we're hopefully sharing with you across multiple aptitudes of business, property. If you're not aware of our group, check us out on our channel. We run multiple businesses, 6, 7 and 8 figure businesses. And this week we've got a lot of tips and hints of things that you can start integrating into your business strategies in both property and business. I was actually at a dinner yesterday and a lot of people around the table were saying there's not a lot of places out there you can learn about business, and I'm telling you now, this is the place. So without further ado, and for podcast listeners, it's 13th of September 2024, and we have a really good agenda today. So starting off, we're going to be talking about anti-embarrassment clauses. A little tip, this is something that sellers put within contracts when selling a building. We'll be talking about progress at the Old Maltings, our site in Abingdon, which is a beast, and we'll be seeing how that is progressing. We'll be talking about selling sites on and taking the margin from future buyers. They always say the phrase, leave a little bit on or leave a little bit in for the next buyer. But this is actually leaving, taking from their future profits and bringing it into your own pocket. So certainly something you need to start into thinking about into your business. We'll be discussing Chertsey and whether it's been sold or not. We are doing an endurance Prokart challenge. So we'll be sharing what that looks and sounds like. Actually, I've got my bag packed and we're leaving today. We're talking about raising investment. Part of the conversation we had yesterday with the group is how we raise capital, and we'll be sharing our tips on the actual process behind that. Boardroom, we had our boardroom yesterday and we talked through the financial management 101. So we'll be sharing what we shared. So that is for you guys to have your end, and you don't have to be part of the face-to-face that the other guys were part of yesterday. And then last but not least, before we go into the Q&A, we'll be talking about what to go into first, business or property. Anything else to add, Ben?
No, all good. Welcome everyone. Fun-packed agenda. So let's jump into anti-embarrassment clauses, because I, before this week, hadn't really heard of what one of them is. So yeah, I'm intrigued.
Yeah, so anti-embarrassment clauses are actually super common when you're buying a building off someone that might be the NHS, the council, the government, a social housing provider, a charity. And it's very alike, because when someone is coming to sell a site, they have got to have their own consultation period to understand the value of that particular property. Obviously, our job is to extrapolate as much value and bleed as much value as we can, is one part, but also buy it at a value where we make a profit. So to some degree, what is the best price to buy a property? One, that it works for you, and two, the minimum value you can get the seller down to. So the anti-embarrassment clause is to protect that seller for any future embarrassment publicly, to ensure that they're not deemed as a rash decision maker in selling a prospect. And the way that a seller would normally do this is have some form of overage provision. And we'll share some link in the show notes of where we actually talk about an overage on our Tame site, or potentially a further payment should further value be unlocked. So this particular site, and I'll give you two examples that we are buying at the moment, is from a charity, and they don't want to be deemed to be selling their office at a lower value than we can extrapolate out of the building. So what they have already done, which is good, to be fair, they pushed a consultant in early days, got consulted that the best way to sell this building is to get some form of planning permission on site. So they have achieved planning permission for 14 flats. It's in a high value area in Surrey, and they are now selling the site with the benefit of planning. What they're concerned about is their consultant has valued the land and set a guide price to push this to market based on that scheme. So when you work from a RICS background, you might go end value minus all the costs leaves a land value, and that land value has been arrived at. But if someone like us managed to hit good timing in the market, which Ben and I are yet to experience, but let's just say luck is on our side and we hit a really good time in the market, and pound per square foot values go up £100 per square foot in that area, which might be a 20% increase on the resales. They want to have their hand out and part of that pie to get a payout at that time. So they've capped a value for the gross development value. And if we hit really high values over that gross development value, we, believe it or not, have to give them 10% gross, is their proposal. That's basically their way of adapting that anti-embarrassment clause. Another time we've seen this, which is when we bought a building off the NHS. It was an old clinic. We actually ended up buying the building and letting it out as a children's nursery, but they also had a provision in there that if we got any residential planning on the site and increased the value by, this one was absolutely astronomically ridiculous. Their clause that they wanted to put in the contract, and I suppose this is another tip, is they said within the next decade, if we increase the value significantly, they get 50% of that value paid down. Now, what all of these sellers that are very green to development are forgetting, to get to that value, you have finance costs, legal costs, professional fees, build costs, carry costs, market risk. You have all of these risks, construction risks, to get to that value. So saying we want 10% of it is probably more than half of our profit. To saying you want 50% of it is a humongous negative. So we're not even going to do that anyway. So
this is on the gross amount you're saying. So if GDP
correct,
is
yeah.
£4 million, they want 400 grand.
Their negotiation is classic, so schoolboy. It's they don't understand the ergonomics of. So this particular charity, when we met with them face to face last week, I said, if you want 10% of the value increase and our margin is 15%, you are taking 66% of our profit off the table. Why would we even deliver that?
Yeah.
And obviously didn't tell them a white lie that we normally squeeze a little bit more value than 15% return on GDP. And also that to us is the cherry on the cake. We're taking all the risk, and our upside should be everything that we're doing extra and taking it extra yard. The NHS wanted 50% on the gross value increase, which is just nonsensical. And I actually said in the meeting last week, if it's pointless us adding the value, we neither of us benefit. So this clause needs to motivate us to work together and add value. So I proposed a net value margin, and we actually have been back and forth, and we've come to they didn't want that because their argument was we could have bled the SPV with fees, which is, a fair comment, and something I have in mind. Only joking. But we have found a sort of middle ground that we would like to push forward to them, because we don't want to be punished for adding value to the building. So a top tip that we did have with the NHS, we just told them to remove the clause because it was absolutely absurd, and they did remove the clause completely. This charity that we're trying to acquire the site from as of today, they are not removing the clause, and they do want very specific wording in. So we're trying to find a solution. Well, we have found a solution. We're trying to navigate that, to communicate that, because it's not easy and it can get complicated. Because how do you, tag it to gross development value or net costs, or but the way that we're actually planning on doing it is on a percent. What we're planning on doing is a £1 per square foot rate on the net saleable area that they have already got approved, and then we're trying to then push everything we get on top of that is ours, and quite rightly should be ours. I think I've covered most of it. But it's crazy. It's crazy.
I mean, if they want that value, then deliver it themselves or add the value through the planning themselves. Like why should they have any of the upside if we're putting in the sweat the finance costs and to everything to unlock it? I mean, it's stupid.
Because I like analogies. Do you want an analogy of what I think this is like? This is like me going into a handbag shop and being like, I like that orange one, but it seems quite pricey. How do I know it's worth that? And they go, well, it's it's a designer handbag. Don't you know your handbags? And I go, well, no, because I'm not a handbag artist. And then I go, I tell you what, I'll buy it off you, but I want a clause in the contract that if it's not worth this in market value, or you've sold me a dud, you have to give me money back. It just doesn't work. Like if you're a specialist in an area, you should get paid for being that specialist. Rob Moore talk, as much as I loathe Rob Moore and his shouty tactics, he does talk about money as a value exchange. And if you're a developer, you should be getting paid for your value exchange, not someone else. Well, actually, in 3 slides time, I'm talking about, as in 2 slides time, I'm talking about benefiting from someone else's margin. But I think that it's it's a mockery. Someone's put it in and they like the clause, and now we've got to deal with it, and it's a pain in the ass, really.
I mean, they're selling the asset as the asset currently. We're buying it, above kind of what the existing asset is worth, because they've taken the time to get the planning approval, which is, fair play on them. But like you say, if we end up getting more value, which we will, why should that be shared? We own the building now.
It's only upside as well, which is what bothers me. Because I said, what if pound square foot go down at £100 square foot?
Yeah.
Do you want to share that? Do you want to come around the table and say, oh, sorry, we did really well out of you 2 years ago. I tell you what, I feel sorry for you now.
Yeah, bonkers. Anyway, interesting. A top tip for people that are buying from the likes of charities and other people. So look out for that if you're bidding on those types of assets. Cool. Progress at the old maltings, which we name Tom. I wanted to just showcase some of the ways in which we have added value. If you'd have seen my sort of social post a couple of days ago, I was talking about almost £1 million worth of additional value, that sort of top line GDV added with some of the enhancements that we've made to this site. And I'm showing a few of them on screen. So where I'm stood in the middle is effectively the old roof space. As soon as we went into this building, looking up, I could see that there was a lot of volume up in a roof zone that was open. It had large king trusses, which you can sort of see some of the remnants of in the image. But there was every chance of stripping some of those king trusses out and utilizing the roof space by adding a new first floor level in it. Now that whole space added about £500,000 worth of top line value. If we're making 20% on that, let's say a little bit more because we already own the space, you're looking at a good 150 grand bottom line profit. So it's things like that you should be looking for when you're working with these types of buildings. Chopping volumes, large volumes in half and adding extra floors. Not just looking at a floor plan and figuring out how you can do things and rearrange things in 2D, but actually looking at the three-dimensional space, using those volumes to chop them up and add floor areas. This image on the right-hand side is another place where I think we've added 160 grand's worth of value. And when I say 160,000 pounds worth of value, how I'm breaking that down is I think we added 40 square meters, and we're looking at about £4,000 per square meter in terms of value. So yeah, 160 grand's worth of top line GDV additional. So that's again a double height space as you enter the building. We've added an extra floor. That's why these lights are dangling so close to this floor, and this will become an extra flat. We've done that in other places around the site, to get that £1 million worth of added GDV. So when you're working on existing buildings, don't just look at floor plans, look at three-dimensional space. And we've done this numerous times, even in Tame, where we've added mezz levels above kitchens that can be used for workspaces and chill out areas, libraries, whatever. So we're trying to not necessarily maximize just the two-dimensional floor space, but we're looking at actually adding additional floor space by utilizing the 3D volume. So yeah, top tips. We are progressing nicely on this site now. You can see on the image on the left-hand side, we've got stud work going up. Partitioning almost complete. Fireboarding of the ceilings is 50% complete, and first fix electrics and plumbing will start to go in imminently. So what I wanted to also touch on is the site tour. So if you want to come and see this site, it's called the Old Maltings. It's in Abingdon, which is near Oxford. This site will be 21 flats and 2 houses, and the 2 houses we're hopeful that we can get planning approval through either this Friday or early next week. We had to do an archaeological report. Thankfully, nothing was found, no human remains or arrows or coins or anything. We did find a small well, but it's not of anything of value. That report's now been submitted to the planning officer, so we should get planning approval for the 2 houses in the car park and the 21st flat as part of that, which also could comprise some external balconies, some landscaping, a new bin store, some garden walls, and gates, and just basically softening up what was an old office car park. So lots of hard standing, but we're bringing it in, bringing more soft planting and things to sort of soften it up and make it feel a little bit more residential. So if you want to come and see, the Old Maltings, which is this one in the top left. We're visiting 3 sites on the 17th of October from 12 till 5. We're visiting this one. We're visiting our St Andrew's Court in Tame project, which the first phase of 9 flats by the 17th of October will be completely finished. And we will be moving shortly into phase 2, which will be a further 11 flats. So that is 20 flats and sort of 6,000 square foot of commercial space. And then the final site that we'll be visiting will be West Street in Marlow, which is another commercial conversion to residential of 8 residential flats. So if you're interested in joining, drop us a message down below. I think we've got a bit.ly link where you can register your interest and join the list to come and visit the sites with us. Last time, I think we had about 40 people, and amazingly, most of the people that came, we hadn't actually sort of met before, which is great. You know, the podcasts, these videos that we're doing clearly are reaching new audiences, and we're meeting way more people through that process. So yeah, if you're interested, sign up below, register your interest, and hope to see you there. Selling sites and taking the next buyer's margin.
Yeah, so if you've tuned into any of our episodes before, and we've actually got a bit of a, to some degree, a site that we're sharing shortly, which is our Chertsey site, which we have sold on. We are developers. We like, you know, breaking ground and building buildings and doing all that good stuff that developers should be doing. But there's also money to be made in other areas, and that could be arbitraging value, so taking something from a marketplace and putting it in a better marketplace, so a badly marketed residential opportunity, and getting some planning on it and then trading it out with planning, or even a development site, taking on a scrapyard, getting the consent and selling it on with planning. You're probably asking, why would you sell it on? Because you're developers, you should be building it out. But there's a very big difference between every different developer and every different wheelhouse that a developer may have. They may have strengths and weaknesses across the board. A lot of our strengths are, you know, the early days on a site. We've got a measured building surveying business as part of our wheelhouse. We've got Aura architecture that we can lean on from a planning and design perspective. We don't have construction in-house. So normally when we bring construction in, there's a premium to that. So a lot of firms that do have construction in-house can probably be a bit sharper in paying for a fully consented site than we could, but they might not have the skills to take it through planning. So they have to pay a premium for the site because they don't have the skills to bring it through planning. So what we're getting at here is it's sometimes worth doing the analysis to see whether it's worth selling a site with planning consent or delivering it yourself. Obviously, if you've already got planning gain in the deal, it's not the end of the world to deliver it out, because evidently you've got margin there already, and you're then teeing yourself up for construction margin. But what I would say is similar profits can be made by just selling on. So if you can visualize that in front of you for the viewers that are watching us on sort of YouTube and video, you can sort of see what I've done here is I've broken out a capital stack of a deal. Blue being land value, green being all the costs on top of the land value or the building value, and then yellow being the profit. Now, we've bought sites before where you can see the level that we're buying a site at in blue, which is above, and coincidentally, the margin that we've had through planning on an open market might mean that a contractor who has smaller construction costs can still make the same profit we would, but pay more for the land. So because of that result, we have often traded sites on and made just the same amount or similar amounts of profit for just trading it on with planning. And that is because we don't have really finite construction costs. And this is a clear example of how you can analyze sites and pick and choose what you might trade in the market and deliver. Evidently, if you're trading something with planning, you don't have market risk, you don't have construction risk, you don't have to deal with delays, you don't have to deal with finance. You're taking that capital and compounding it back into reinvestment into the business. So there's something to be said for that. Obviously, the main two factors that you have to consider are two things, in my opinion. One, pipeline. Have you got the pipeline to do it? Because if you sell the site, is your 2 project managers going to be sat there twiddling their thumbs, throwing scrunched up paper at each other for the next 6 months? Or do you have something else they could spend their time on? Rather than going, and I'm sure Tom would be very pleased to, you know, take a trip to the Maldives for 6 months or something along those lines. So you've got to think about pipeline. Can you facilitate the pipeline to deliver and sell at the same time? That's a perfect balance, because you've got cash flow lumps coming in from a planning play, and then you've got delivery lumps coming in as well. So you're getting planning and construction margin on some sites, and just planning margin on others. So that's something to consider. And then the next thing to consider is the cash flow of the business. So you're obviously, if you do have a really good pipeline, and you want to be delivering that particular site because it's a good site and a good location, you think it's low risk, think about also how you're getting there at what's the next year cash flow looking like. What are you trading at? What are you leaving on the table by getting rid of the site? Because we have sold sites that have made a 60% return on the profit we would have made if we'd have delivered it. But though having that 60% of cash in the business 2 years sooner, one, makes the cash flow help the business run day to day and keep the lights on and pay the staff and focus on other projects. But two, that 60% might be 100% within that 2 year period anyway. So it's thinking about the compounding value of the cash flow of the business, and what that does for your business. So just something to consider. If you're thinking to yourself, right, I've got a really strong pipeline, our skill set here is taking stuff through planning and bringing stuff to the point of construction. And if you don't necessarily have the cheapest construction costs, definitely something to consider doing as well.
Nice. Anything else?
No.
Cool. Oh, was I meant to do an animation?
Yeah,
there?
so there was for the visualizing there. I've actually put the same profit in there, which is the land value. Yeah.
So this is us stealing profit, is it?
Yeah, it's taking their profit. Well, taking our profit out sooner, and then they still have their profit in it. Is basically
nice.
Yeah.
Very good. Cool. If you enjoy listening to this podcast, we would love you to rate us on Spotify and review us on Apple Podcasts. And the main thing we ask you to do is just share it with one person. We know that there's a lot of people getting good value from it because we get lots of messages. So thank you very much for that. But we want to share it even wider. So yeah, if you could just do us a favor and share it with just one person that would benefit from growing their property business or just growing their businesses in general with some of the tips that you hear on these podcasts, that would be much appreciated. Cool. So yeah, big news this week. We managed to get the Chertsey site that we spoke about last week sold. So we exchanged last week. We sold it on Tuesday this week, I think.
Yeah, Tuesday.
Yeah, do you want to give a little bit of a breakdown? We've actually got a question that we had from Jimmy, which we're going to touch on at the end about stamp duty on this site and the sort of way that we purchased and sold it. So stick around to the end and we'll answer that. But Jack, did you want to touch on anything from this sale?
Yeah, so, I mean, touching on the last slide, really. Our pipeline, we just feel that we're constantly looking for deals. We have to be on the hunt for deals 24/7, and that has aided us to be on site. We're on 5 sites at the moment, live sites. That's enabled the pipeline to be where it is today. And some of those sites we're on today took a year to get over the line. Some of them took 2 years to get over the line. So you've got to be thinking so far in advance, and it's kind of panicking me that we don't have anything at the moment for Q1 to Q2 next year. And we're thinking about that this early to push these sites forward. Chertsey was one of the sites that could have slipped into that sort of Q1 date, but it didn't. We went through the planning process. That we secured the site to buy unconditional. Which is, we actually got asked a question yesterday in our boardroom. How do you de-risk things unconditional? There is a value that everything can be done unconditionally because there is an existing value to a building. So we agreed to buy that site unconditionally. And while we've got all of these other sites in delivery, we were focusing on the planning play to get permitted development to convert this building to 9 units. The news didn't come quite back as we had hoped. We actually had a bit of a battle even approving the existing use, the certificate of lawful use, before we could then go back in for the prior approved planning application, which was hugely arduous. And we were doing that because we're rolling the dice to get another site in our pipeline that's a 9-unit PD scheme in a great location in London. The reality is there's a bit of a dismay in the planning process at the moment in this location. So if you've got any sites in this area, be cautious around flooding. And it's not unique to the site, it's more access locally. So it kind of impacts everyone, sort of like the water neutrality issue. Like they're unkeen on really flying things through planning and hitting their targets because of this particular flooding issue. And as a result, how do we get out of it? And we secured it at a good value. We knew that we could trade it out, and we basically, traded it out to de-risk the deal and move on to other things that were probably easier wins and lower hanging fruit. And we did. We ended up getting the contract agreed, exchanging on the site ourselves, allowing enough time between exchange completion for a new buyer to come in at a better value to cover our asses, basically. And we managed to find a buyer who then exchanged last week and completed on Tuesday. So it's gone. It's a little bittersweet because you visualize what the scheme's going to be, and it should really be 9 apartments because it's surrounded by resi, but the council are the council, and we'll leave that there. But yeah, you have to win some and you have to lose some. This is one we didn't necessarily win on, but from a learning perspective, make sure you're de-risking exits and making sure you have multiple exits so that you're not buying a site in a lump with something, because we could have been waiting 6 to 25 months in planning on this site. So it just puts it into perspective to carry the debt for that long. If it's not guaranteed, we've got we've got bigger fish to fry and better deals to focus on.
Yeah, and it's worth saying because you see on social media a lot where it's all positives and everything's going swimmingly, etc. We kind of washed our face with this deal. We didn't make any sort of real profit margin on this. It was given the way things went, it sort of washed its face, and we've got our initial capital back to go again, but we didn't make any money on it. So not everyone's a winner, but like Jack says, when you're filling your pipeline with enough deals, you're hoping that 4 out of 5 are great and profitable deals, and you might have one dud that pulls a few down, but that's the reality of development, which you don't often see. So yeah, thought worth saying. Cool. This week, we're going to head off after this really to the Daytona Prokart Challenge. I didn't actually realize it was such a big thing. I was just been on the website now, kind of flicking around, but there's going to be a lot of teams there. It's an endurance race, which is for 6 hours. We've got a team of 10, is it?
I think it's 9 of us. Yeah,
9 of us. Yeah, it's 9-10 people. So we're going to have stints in the car, 20 minutes here, 20 minutes there, and chopping and changing. There's a pit stop challenge, so we'll be learning how to change the tires, and there'll be a time for the winner of doing the fastest pit stop. So yeah, really looking forward to it. There's a lot of property people there, and chances for networking tonight with the people that are attending. Good sort of team building with XP and the wider group, because it's not all just the XP group that are taking part in this challenge. It's some of our other contacts outside of the actual businesses, so building relationships there, investment partners and contacts, and strengthening relationships. So looking forward to it. Raising investment. So we have raised the best part of £14 million in equity over the last 6-7 years. About, what was the last count, about 40 million in debt. Yeah,
it's actually just under 16 million now, and yeah, 48 million in debt. I read a hilarious Instagram profile earlier today of another property person that had raised 2 million in private debt, but only done 1.1 million in GDV. I was like, how does that work?
Somebody's profile needs updating.
You made 900 grand just in over raising.
I guess sort of part of what we want to touch on here is, we've kind of been doing this a lot over the last 6-7 years. We've raised a lot of money through equity partnerships and also the debt senior provision. So Jack certainly has got a huge amount of experience in going through that process, and it's taken 70-80 calls to actually raise funding for some of our recent projects. So we've learned a lot through that process. We've spoken to a lot of people. We've had a lot of coffee meetings, and Jack was just going to talk through some of the conversations we had in our boardroom group about how we've done that and how people should look to raise cash.
Yeah, so I mean, we just keep it simple. It's a really difficult thing to try and teach and implement into your own business. It's kind of, you will find your own process. Raising capital that's not institutional, so with high net worth and ultra high net worth, is fundamentally to rely on your own network that you've got to build and grow, and then rely on their network as well as yours. And you can start with equity brokers and get introductions, but in reality, the amount of brokers that I've spoken to that go, yeah, we do the full capital stack, we can get you an investor, it sounds great, but they don't really introduce you to Joe Bloggs that's got 4 million in the bank account and wants to chuck it your way. The golden goose of our life as property developers is finding the sites and funding the equity. You know, and there's all the bigger players out there, like the big players like the Barretts of the world. They've got like 3 billion in cash, and they don't have to worry about this. But for us SME developers, and we're growing, we do need equity. If we want to, I mentioned we're on 5 development sites at the moment. We can no way fund that ourselves at this moment. You know, we're 6 years young as a business. The deals that we were finishing 3 years ago just about cover the soft costs from the profit proceeds that we, you know, push forward. So we're fundamental for our investors to get a return on their capital, and they're fundamental for our business growth. And we built this process out and tweaked it and refined it. And actually, some of our boardroom are amazed that, you know, even the sophistication of raising £1-2 million worth of capital, we still keep the same process that we have since the day we started. And what we do is very simple. We have an Excel spreadsheet, which is obviously very confidential, so it's hidden away where no one can find it. And every time we meet anyone that's expressed an interest in investing in capital, which, believe it or not, you have to be comfortable to talk about that. To even drive any of those conversations. You know, it's not as simple as you walk into a business meeting and you go, have you got money? Do you want to invest in deals? You know, but you can say, you know, our business is a SME property development business. We have a lot of things in house, such as our, you know, the architectural business, the measured surveying business. We're very good on delivery, and we've won awards doing that. So, and we partner with investors to give them a return on their capital on our projects. And you know, that alone might get them thinking, but you put their name down and you follow up with them. Every person that has ever expressed any element of investment or working with us from an investment perspective, name goes on this list. Then we make sure that it's another call or a coffee, face-to-face meeting. We want to make sure that every single person on this list has been met for a face-to-face with myself and Ben. And what we do is we fill out in their details, their contact info, their email address, their phone number, the size of investment that they're likely to be talking about. These are things I used to find it so difficult to say, so how much money do you think you'd be willing to do on the first project? I used to find that difficult. Ben, I don't know if you're the same. Like when we were back in the early days, saying to an investor, how much do you think you would have available to invest, just felt so much like a faux pas to me. Like you didn't talk about how much money you had saved in the bank account. You just kept that stuff to yourself. I think that's us being British.
Yeah, it's very English. It's a very English thing, yeah, to be a little bit coy about money, and it is like for the most part. I think that's how a lot of people think. But I think certainly over the last couple of years, it's changing your mindset from "I need you" to "We're providing the opportunity here for you to make a shitload of money." You know, it's that value exchange, like you, yeah, well, yeah, it's that value exchange, like you talked about earlier. It takes both parties to make it happen.
Yeah,
you are, you know, you're gaining from it, but also you are also providing the opportunity to give a return on the cash. So it is a different way of thinking. I think you just have to be very, very business focused around it. You know, that it's and when you get to the point of having high net worth and, you know, ultra high net worth people that you're speaking to, I hear the terms, you know, deploying capital. It's as robotic as that. You know, they need to deploy this capital. They need to deploy their funds to make it work for them, and that's what they have to do. So when you're speaking to friends and family, it's different because they're not looking to deploy capital. It's not as businessy as that. It is potentially their life savings that they want to invest and make a good return on. It is a slightly different conversation with the different type of people you speak to.
Yeah, you kind of want to work with the people that, even though it might be uncomfortable for you to ask that initially, that they want to hear that question. If they don't want to hear that question and get touchy about it, you know, it's probably not the right investor to grow a scalable investment development relationship.
Yeah. I think I would always, or I did always approach it saying something like, how much would you like to invest? You know, and just sort of pushing it over to them. And yeah, I guess I didn't have too much of an issue with sort of saying that from too early on, because there's no other way around it. You can't just beat around the bush and sort of start talking about a project that's either way out of their, you know, budget range or way too small for what they're looking for. You need to get to the crux of how much they're looking to invest very early on.
Yeah, we so you get their sort of rough size of investment, then maybe future investment. You make some notes, really, really key that you make some notes on where you met them, who you met them through, who was the introduction. But write as many notes as you can. The terms that they're likely to be having, it's a common question that we ask if you would be interested in loan or equity to start going. Most say, interested in both or specifically only this particular investment. And then what this spreadsheet does for us is it captures everyone that we could do projects with. So it's a selective list of people. We'd like to think that we're certainly on trusted first name basis. We've met them face to face with every single person on this list. And then when we get a project, we think to ourselves, who would be the best suited sort of person for this project? And that's where we start. We start with that person and we go to that individual and say, I've got this project, and that might be location specific. That might be type of project. That might be risk appetite, if it's a planning play, for an example. That might be, even as simple as, what type of loan they were wanting to do, and the amounts match up. So we go through that list, and what that list then does for us is every investor that invests with us, it has the quantity of investments and quantity. I've just said the same word twice. It says how many times they've invested with us and the quantity of the investment all into one. Then what it does is it populates the highest frequency and the highest number to the top, so that when we're looking through our investor deck on a new deal, we're spending our time with people that have invested more times or more money before, which is obviously a more efficient use of your time. We make a note next to their name. So for an example, if we then, on that particular deal, which is a column, we might say we've sent them the deck, this was their feedback. So we have that information, their feedback information, who we approached, what they said, what they liked and didn't like about it, all on that spreadsheet. So when we're funding a new deal, we can hopefully cater a better deal for that particular individual. And that's pretty much how we do it, just on a spreadsheet. And I know that that's not rocket science, but that enabled us to raise, I think, close to 6-7 million last year in investment, maybe even more actually, within 1 year. And we talked about our journey to £10 million before. We talked about the journey of those new sort of institutional funders and how we reverted back to our old school process, just improving it and refining it. And that's all about process, the people on it, the time we're spending, and also prepping them. We want to make sure that is your investor list, your investor people are already prepped, so that when that deal comes through, it's not just re-steering a big old ship to them to get comfortable with you and do face-to-face meetings and understand how your business model works. That should all be done now, so that when the right deal comes along, it's just getting comfortable with the deal. You want them to underwrite you now and the deal when it comes.
Nice, good. And if if you are an investor and you want to look into investing in property developments, property investments, and you'd like to come and have a chat with us, I mentioned it earlier about our site tour. I have just where is it? I've just got a link sorted. So it's the 17th of October, 2024, 12 till 5 p.m. You can sign up via this bit.ly link. So bit.ly/XP tour for those that are listening on the podcast. Register your interest there, and we would love to speak to you on the 17th. Cool. So we had our boardroom session yesterday, like we mentioned, and one of our mentees asked about financial planning and financial management, sort of 101 for developments. And we're going to spend a couple of minutes sort of explaining how we do things. They did everything on spreadsheets, which kind of has enough information to grow to a certain size. And when Jack and I started out, we would have our kind of main pipeline spreadsheet, and we sort of had a very, very loose kind of overheads and sort of revenue expected, cash flow forecasting and all that sort of stuff. But as you grow, you're going to need more than that. And the one thing that I would recommend for everyone to do is to get a subscription to Xero. That's Xero, Xero. It's an accounting software. I've never known anyone that's moved on to Xero that's moved back over to something like QuickBooks or Sage. Xero is extremely sort of user friendly. It can do everything that you want it to do from a reporting perspective, budgets versus actuals, profit and loss, balance sheets, and all these other things which we're going to come on to and talk about. But some of the things that we spoke about yesterday in our boardroom session is the people that you need in that sort of accounting process within your business. Now, these can be internal or these can be external. When I started Aura 7 years ago for £150 a month, I had an external bookkeeper help me with all of my admin and my accounting. So there's four key people that I think you need in your, in or outside your business. Somebody has to, play this role. Number one is some form of administration, preferably in-house, because actually they will be the people raising invoices day to day, managing invoices that come in terms of they come to you first before then sending them out to your bookkeeper or your accountant. So add some sort of administration in-house. Secondly is a bookkeeper. Now the bookkeeper is there to utilize the Xero accounting software, receive invoices from your admin assistant, reconcile bank transactions. So as soon as a bank transaction comes in, it's reconciled to the accounting software. It's coded and it's allocated to a project or a part of a project where it can be tracked and be pulled into all of the reporting that Xero can do for you. What you'll probably want on top of the bookkeeper is somebody like a finance manager who's a bit more experienced, can look at the bookkeeping that's being done, check that everything is done correctly from a VAT and a structuring and a coding perspective, and present the information in monthly management reporting and meetings. On top of that, if you're at the sort of stage that we're at and we're looking ahead a little bit further and we've got a lot of things that we're juggling and we need a bit more strategy, you might then want to get a finance director involved, so an FD. And those are the four people we think you need. Now, this doesn't have to be expensive. We use the same company for our bookkeeping and our financial management, and then we bring in some external help from a financial director perspective as and when we need it, and we just pay a consultancy basis on that. And then the admin in-house, when you're first starting up, that admin probably is you, until you bring in some admin help. That might be you doing the invoices, forwarding them on to your bookkeeper. Once you've got all that in place, you're then going to be looking at your individual projects and your business as a whole. And to run a successful business, you're going to need some form of management accounting and management reporting. And that, for me, has three key elements. And those three key elements are profit and loss, your balance sheet, and then your forecasts. So profit and loss will sort of give you a snapshot of day-to-day profitability of the business, looking at your sales, your revenue coming in, your cost of sale to give you your gross profit margin, then your overheads, which then, when you deduct all of that, you get your net profit margin on a monthly basis. Your balance sheet is where your assets sit. So this really shows you the sort of true wealth and health of your company. It's going to have your assets and liabilities. Some will be current liabilities or longer term liabilities like loans, and any invoices that are outstanding, the cash in your bank, and that will give you kind of a statement of wealth, a net position. So your assets minus your liabilities, you'd hope that you would be in a net position once you deduct your liabilities from your assets. And then your forecasts are all about forecasting forward. So in our development business, we look more like a 3-year forecast, because fundamentally projects that you start now might not finish until 2 years in the future. So you want to know that, when those come in, what cash position are you going to be in? What costs are you going to have to outlay? And, it chops and changes. Jack and I will meet on a probably 2-weekly basis to just look at cash flow forecasting. Has there been any slippages in projects whereby it's moved a couple of months, or we know that it's not going to be finished on time and we have to allow for, some lag in those funds coming back into the business? The idea of the forecast is that once you've got all of the projects programmed into that forecast, you can then see where your cash position is. And our finance manager, which I mentioned in the first section, our bookkeeper and our finance manager helps us with that forecasting. So every month, effectively, the forecast is updated with the historic information so that we can then see our cash position at the start of the month, what's happening this month and how it affects things going forward. And your forecast will be the thing where you look at if a project does slip or your sales slip into the following year or a couple of months, and you forecasted them in for this month, for example, you might have a 50, 60, 200, 300 grand red area in your cash position that you have to plug, and your forecast is going to show you that. So yes, these three things are super important for any business, whether it's a development business or just a SME business like Aura and XP Surveys. These are the things that we review on a monthly basis. We sit down with our finance manager at the end of every month once everything's been reconciled. We review our profit and loss position. We have a look at our updated balance sheets, and we review our forecasts more regularly than that, because within a development business, when you've got 5 projects on the go, they all interact. And what you don't want to do is have a sort of house of cards scenario where one project really goes tits up. You forecasted for money to come back into your business to be used elsewhere, but you don't have that money to use because there's been delays and overruns in costs, etc. So to keep a healthy business, to keep your financial planning in line, these are the things that we do. If you've got any questions on that, drop them down below, because I know that was a really big sort of quick whistle-stop tour of what we do. But fundamentally, if you're not using Xero, you need to be able to report on all of your financial health within the business, and Xero is a great accounting software to do that. So make sure you get that first, put your team in place, and then make sure you have regular monthly management accounts created so that you can understand very quickly the health of your business.
Ben, I've got a question for you to hopefully prove the importance of all this. Would you rather, so the challenge is I've got to give you some seed capital and you've got to go and set up your own business and brand new, clean slate in anything, for an example. Mm-hmm. Would you rather have, sorry, that's cheddar. Would you rather have £250,000, £250 seed capital to set up this new venture, or 175,000, and the second option, the lower amount, you're allowed to use all of these tools. You're allowed to have an admin, bookkeeper, finance manager, FD, profit and loss, balance sheet, and forecast. But the other £250,000, you have to be completely blind.
I mean, I'd rather have all of these people in place, because that 75 grand would easily be gained back faster by having these people in place and having
correct answer.
Yeah, having the management there ready for you to use. So it actually doesn't matter what size your business is. You should start putting these things in place. I've done so much business coaching with like external people in like a group structure, whereby you can clearly tell they don't understand the finances in their business. Their invoicing is done via a Word document that they have to file and spend loads. No, the £25 a month Xero subscription fee is saved purely by the inbuilt invoicing process. If people are using PDFs and using Word documents and sending out invoices via emails themselves, and the amount of time that this accounting software will save you should allow you to bring in a bookkeeper at £150 a month. That's what my bookkeeper cost Aura in the early days, to give me everything that I need and free up my time from all of this stuff. So yeah, it's absolutely needed. Cool. If you want to sort of learn things like this, this is one of the topics from our boardroom yesterday, and we had 12 people in the room yesterday. The Aura office actually is probably a bit too small for the amount of people we've got in the boardroom.
And you've got a couple more spots, haven't we?
Yeah, we can't really fit many more people in. We'd like to get 1 or 2 people signed up. So if you are still interested in joining us on a monthly basis, every quarter we meet face to face like we did yesterday, and the other ones are on Zoom. So we meet for half a day every month. We talk about goals and hold you accountable to achieve them. We also do some deal clinics. I think we talked about 4 projects yesterday, helping some of our mentees to sort of appraise sites and maybe thinking about things that they haven't thought of, utilizing the sort of shared experience within the room to give some guidance, really, hosted by us. And it's very valuable, I think, all around. We learn something every time that we have these as well. and we know that our mentees, get huge amounts of value from them. So if you are interested, comment Boardroom below, or reach out to one of us, direct message us, and we'll send you the details. Cool. Capacity planning, point number 8.
Yeah, I mean, it sounds really comprehensive, but my actual sort of touch point on this isn't that comprehensive. Really long story short, we've got a flip that's sort of in legals and due to exchange very, very soon in Central Suites. It came around really quickly. We got offered it cheap. We had to be quick. There's good margin to be made, but as a result of that, it's all sort of, you're already on the back foot trying to scuttle things around and get the site bought. It's just a property that we're renovating and then selling. And coincidentally, I sort of pushed this over to our builder, which is Richard, who's doing a few bits in XP and a few bits in Central Suites and another project coming up in Central Suites. I sort of said, we got this project coming up. Do you have capacity? And guess what he said? Yes, of course I do. Wouldn't want to let you down. Which I said, letting me down would be overstretching yourself and slowing down other projects. So don't just say yes to not let me down from a yes man perspective, but actually be honest with yourself and sort of understand your deliverables. Now, in reality, I know, we trust him really well and he would get it done and he would do late nights, weekends and get the job done. But do we want to go through that sort of risk and rigmarole? So it's just actually about challenging that, even if you trust them with your life, trusting those partners and saying, in reality, I know that you've got a lot on. Do you really need another headache? Do you really need to be going to another site to meet the skip man just to get the skip dropped on the driveway and then going back to another site? Overstretching yourself is something you need to be cautious of from a capacity planning place. And then also the people that are feeding into you. Now, on bigger projects, we do vast assessments on contractors before we start working with them. The capacity planning on a contractor on a £2 million job is we make sure that they're turning over sort of 4x what the job contract is. They can prove that they've got the balance sheet to do it and the cash flow in the business to do it. They can prove they've got the resource to do it. They can prove they haven't got too much business coming in that they can't put it on site. When you're working on flips and renovations, that's all a bit too comprehensive, but think about it in the same context. You don't necessarily have to have all the pre-questionnaire qualification questions. You can actually just ask, what have you got what have you got on? What have you got coming up? Can you actually deliver this at speed? Will it impact any other projects that I have with you? So just challenging them really, and making sure that the people feeding into your business and impacting your business are also not at capacity.
Nice. Yeah, it's so crucial. Cool. Business or property first? This is something you wanted to have a little chat about, is it?
Yeah, I mean, there's no agenda on this, so it's probably me and you sort of leaning back in our chairs and just sort of talking what we think. We're obviously already years, almost a decade into running businesses and setting up businesses and also property stuff. So, it'd be interesting to hear your views. But it was actually brought to me by one of our guys in the boardroom who actually is in property, but he started off as car salesman. Well, when I say car salesman, that's not accurate. He trades cars as a business owner. So a car salesman is, the Terry Tibbs. He's not that. He runs the business. He buys stock in, sells stock. And he was just saying how he loves business more than property. Property was the thing that he puts his capital into, that spins off the business. He was saying he can buy a car for £3,000 and sell it on for 6, and that can be a week, and then he's back. He's got 100% back on his money, and he'll do it again. Which I love. I love that business side of things, and we talk about it time from time. And we're both big followers of James Sinclair, who's a massive advocate of business over property. Property is the slow stuff that you sort of park it in and think about for the longer term, the pensions, the kids, and all that sort of legacy stuff. But Ben, over to you.
Yeah, I'm business first, if I'm honest. I think over the last 6-7 years, my love for business has grown far greater than my love for property. I've been in property since, it's what I studied, architectural engineering. We've been doing it ourselves for 7 years in terms of a development perspective. But before that, it was the Berkeley Group and it was an architecture practice. So it's always been property. What I've loved over the last 7 years of going out and doing my own thing is the business side of it, learning about sales and marketing and finance and how to operate businesses, how to build teams. And it's all transferable stuff, regardless of what the business is. And what I think kind of property is hard. That I think is, property development itself is bloody hard work. And I think people don't realize that. And I think there's been a lot of people in the last 2 or 3 years that set out from a commercial job as an agent, or working for whatever, but jumping ship and trying property development full time, and after 2 years have gone back to work 3 days a week because they need the cash, and they realize how hard it is, and they realize how slow it is. So I do think, I'm very, very grateful is not the word, because it was what I planned to do, but without having Aura running around in the background and ticking along and paying me, paying my overheads from an early time, and paying the mortgage, keeping the lights on, keeping my lifestyle afloat, property would have been way harder. So having that business that's generating, like you say, James Sinclair calls it the quick pounds of business. I think it's fundamental, if I'm honest, having some form of cash flowing business. I guess you could, when these property education platforms sort of show you how to start, they often try to make you start as a deal source or a rent to rent strategy. The reason being, those are businesses. It's in property, but you're running a business. So I think that's why, because it's the faster cash flowing type model. So I would always go, I would always go business. My love for property is dwindling, to be honest. It is hard work. And when I look at kind of the lifestyle businesses more so that we've got with Aura and XV Surveys, getting that regular monthly profitability and feeling more secure from that perspective appeals to me way more than having now big lumps of cash after a 2-year process. I'd love to hear what everyone else thinks, down below, business or property first. What are your thoughts? Type business, type property. I'd love to see the split, and maybe we'll whack a Christina. You could do a poll on Instagram to get some ideas from what people are thinking. But yeah, that's my thoughts.
Yeah, I think that I completely agree. I think in property you'd be doing really, 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 really well to make a 20% margin on anything. I just think that it's near on it, almost impossible to make anything more than that. If it's a flip, it's a HMO, if it's a development, you're working on those margins. That's just the nature of it. In other industries, you can be 3-4xing your margin. A friend of mine runs a food van, and his cost to get a product made is like 40%, including labor, rent, product, everything, all in. His variable cost for getting that unit out is 40%. So therefore you can really see the cash come in a lot quicker, and it's immediate. He might make £3,000 profit in a day, but that's every day for 10 days, and that's his margin. Whereas we're constantly fighting for a profit in 2 years or in 8 months, or when that one sells and it's now pushed back, and all of that sort of nonsense. So I do put huge value in, profit first, which comes business work first. I think that a lot of the successful businesses out there, they start on the tools as a fee earner first, and then they transition themselves out into, the bigger and better things, and maybe the property stuff thereafter. That's quite key, because if you're not as a fee earner, it's difficult to grow a business that cash flow positive from day one and grow it. Because you are an overhead to the business, but you're not constantly bringing in value to that business. So XP Surveys, for an example, Ben and I are not surveyors. We weren't drawing from day dot because we've got other stuff going on. But if we were drawing from day one, that would have been a high margin, profitable business, and we would have been paid very well to do that. But it's not, because we don't do that stuff. So we've got a team that get paid for that, and we've got to try and build a systematic business that can be scaled and grown, without us being obviously in it. So that takes some inertia time to get profitable and cash flowing well. But once it is, hopefully it will be even more profitable and cash flowing, because it's not got the limitation that the directors are just surveyors and don't understand X, Y, and Z. And we take it to that step further, which is the whole goal behind XP Surveys. But yeah, I'm obviously from a family of business entrepreneurs. We're in property and construction, but my dad ran believe it or not, a site unit rental company, a toilet hire company, and then a plant hire company. So none of that owned any assets until, well, actually probably till 2000, after 20 years of trading, and all really successful companies, and very high cash flow businesses. Some of his contracts alone, he'd make 10, 20, 30,000 pound on a particular contract. And that's really big, high cash flow stuff, just whacked in one bunch. For an example, he used to supply all the, basically all of the facilities for London Marathon, and that event alone could almost pay his annual cost to run the business. Yes, it was stressful. Yes, no one else really wanted the job of, sorting out all of the welfare for that type of event. But there's margin to be made in it, and there's that then those funds can go into the real estate side of things that is a bit more boring, dry, and asset backed, and doesn't rely on the weather being good next year. It is there. Someone lives in it and it pays rent.
I think there is a common misconception that property, can be a quick win and you millionaire, very quickly, and that's just really not the case. Like you say, a lot of people start the businesses first, then invest any spare, profit and money within those businesses into the assets that then create kind of the slower, wealth building type things for the longer term. But the barrier to entry and the cost of starting a business is very, very low compared to property. And you're reinvesting your money that you're making in the business. But fundamentally, starting Aura, starting XP Surveys was a few grand in reality. And those businesses now, generate, profit every month, and the team is there to kind of work with us, and we've managed to build the team in certain businesses to step away and only do a certain number of hours a week, because it's been built. So you can build businesses to be relatively passive as well, and that's obviously the main goal of people coming out of their full-time work and going into property, because they think it's passive income. I mean, I don't really believe there's anything passive. You have to put some effort in to then get that recurring income, and that can be done with business as well. I don't know how long it would take to build a property portfolio to kick out what I make on a monthly basis in Aura, for example. It would probably take 5 or 6 years. Yes, you've got the capital appreciation, you've got the the relatively recurring income from that property at that point, and if the business folds or it closes down or whatever, then I lose that. But for the time being, I'm making that, and I can then invest it in the slower pounds, which is the property and the asset building. So yeah, business first, property second, as far as I'm concerned.
Same. Although I kind of didn't do that, but there you go.
Yeah, nice. We'll end on a question that Jimmy asked last week. So Jimmy, thank you for tuning in. I know you've asked a number of questions, which is great, and you tune in regularly. So mega valuable episode again. Thanks. You didn't share the numbers on the subsale deal from Chertsey, but how does it work with SDLT, that's stamp duty? Do you benefit from 100% stamp duty relief regardless of the subsale price? What I mean is, if you bought the exchange for £400,000, you still get 100% stamp duty relief, whether you subsale at 350 or 450 grand, regardless of making a profit or loss. Basically, when we sort of subsale the site, so when we completed on the sale to our buyer, and because we sold both on the same day, there is no stamp duty for us. There will be stamp duty for the end buyer. But because it was a sub-sale transaction on the same day, all happening at once effectively, there's no stamp duty for us. Hope that answers your question.
An easy way to picture that is what is land registry told? That's the easiest way to picture it. So all of this sub-saling contract, let's say you had 4 sub-sales all going on the same day, an exchange on 4 contracts. The completion of the last contract, if it's all on the same day, is what land registry is notified of. So that's the value that the SDLT is triggered at for one buyer. So that's the easy way to picture it. What is registered on land registry? If you buy a site and then sell it on someone else the day after, there'll be 2 applications to land registry.
Yeah, that's a good way of looking at it. Stamp duty, land tax, SDLT. Cool. Perfect.
So
All right.
We're not tax advisors, so if you want real advice, we've got a company that we can make an instruction to.
Yeah, good caveat. I like that. And on that note, we'll end for this week. If you got value from it, please do share it with just one person, comment and like down below, and we'll see you again next week.
Bye.
See ya.